Hi traders and welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to provide you with the latest news in FX markets as well as some charts to watch. So let's get started then. We've got some interesting data that we had yesterday and we had some interesting data and we have some interesting data coming up. So the big story today, we're going to talk about retail sales, how retail sales impact Forex markets and what it means for central banks. But let's have a little digest of what happened yesterday in the market. So what we saw yesterday was the CPI release. And we were talking about this as being a very important piece of information that the market was going to receive, right? So we were looking at the core inflation rate in particular, year on year, as well as the core inflation rate month on month, because that is the one the Fed cares about the most, right? Core inflation rate. So we can see here that actually there was no deviations from the forecasts, right? Actually, the forecast for the core inflation rate month on month was 0.2%. Came in at 0.2%, right? Core inflation rate year on year, forecast 2.5%, came in at 2.5%. So there was no shocks yesterday in terms of that inflation data. What it does show us is that inflation is still a little bit higher, right? It's still a little bit sticky, right? If we look at the inflation rate year on year, previously was 3.4%, came in at 3.4%. So no real changes on the year really for CPI. So that suggests that actually inflation is still a little bit hotter at the minute. Now, if we go take a look at the CME Fed watch tool and see how bond traders are pricing this, we can see that the likelihood of a hold has gone down. Okay. So despite a little bit of a hold in inflation, we've actually seen rate increases come in lower. Okay. So if we take a look at here, there is now a 65.9% chance that we're going to see a hold versus a 34.1% chance of a rate cut in September. If we look at the table down here, which shows us the target rate in basis points versus the probability percentage over a period of time, we can see that a week ago, okay, it was a 45% chance that we would hold interest rates at the current levels, right? And 55% chance of an interest rate hike. So chances of a hike are coming lower. Chances of a hold are moving higher. That is also being priced in the bond market. If we go take a look at the US 2-year bond yields, we can see that they are falling, right? Prices are now breaking out of this ascending channel and we're starting to move a little bit lower. Now we're still above the 50 moving average, which I want to see it get below. If we can get below the 50 moving average, then I think that's going to be the real tell that we're going to see declines in bond yields. That would be very positive for things like the stock market, which has already reached new all-time highs. If we look at the S&P 500, for instance, and if we look at the NASDAQ as well, NASDAQ also not all-time highs yet, but is looking for a potential breakout. We can see actually there's a really nice pattern developing here on the NASDAQ. And this is part of the chart check today where I like the look of the potential breakout here on the NASDAQ. And if we're looking at it from the WCS method, right? So whenever I look at a market to trade, I look at a 3-step process. We look at why the market moves, the conditions around that market, does it match up with the why, and what strategy are we going to use to potentially take a position, right? So why could the NASDAQ move higher, right? Well, what we just talked about, there's a potential that CPI data stayed the same, but bond yields are falling. If yields fall, then there is less chance of a rate hike from the central bank. So We can see that on the CME Fed Watch tool. If that's the case, stock markets tend to perform better. Why? Because it means that their borrowing costs aren't going to change, right? It means that the borrowing costs aren't going to go up either. So there's potential for it to stay the same. That's why we've seen the S&P 500 blow out and move to the upside. Now, if we look at the NASDAQ here from the 4-hour chart, we can see that we're trading above the 50 moving average here, which is a positive. We're trading above this previous resistance zone, now could become support with the $28,800 area. And now we're forming a ascending triangle pattern, right? So the ascending triangle pattern is when we get a base of resistance, right? So in this case, we've got this base of resistance at these structural highs, which are around that $29,908. But look at the lows. The lows are getting higher, right? We're getting higher lows into this level. So what we could be looking for today is if price breaks out, closes above the ascending triangle pattern highs, that could be our trigger point to look for a long, stop loss below the low, target the all-time highs on the NASDAQ, right? If you go take a look at the volatility index, we have continued to drive lower on the volatility index. So we talked about a potential low coming in the stock market on the 29th of July because price had broken the 20 level and then rejected. So we expected a low to form in the market, and that's exactly what we've got. VIX is trading at 14.5, which seems to be very, very low to me, which suggests that the market is very much in that risk on mode. We can also look at something called the CNN Fear and Greed Index. And this shows us what's going on in terms of market participants' hunger, right? So what is their, how do I describe it? What is their willingness to participate in this move, right? So we can see that we're now at 62 on the Fear and Greed Index, right? A month ago, that was in the fear camp. It was 40, right? A week ago, we were at 58. Now we're at 62. So the market is getting more bullish here. And that's why I like the idea of potentially seeing the NASDAQ break out. So the US 100 or the NAS 100 or the US 100 for you guys on your trading terminals. Because we can see on the 4-hour chart, we have this really nice ascending channel starting to build here. So I like the idea of potentially looking for a breakout of this move in here, looking for the market to take out these resistance highs. So let's say a breakout above $30,000. That breakout there could trigger a long move up into the all-time highs. Okay, so that's what I'm going to be keeping an eye on when it comes to the NASDAQ. Okay. Now, we do have some important data coming up. So what I want to talk about is the important data. So first of all, we have today PPI. Okay, so what is PPI? PPI is the Producers Price Index. Okay, so let me go to today. Okay, let me just open this up. So the Producers Price Index, okay, US Producers Price Index for final demand, right? So this measures how prices received by domestic producers have changed over the last 12 months for goods. So this is the year-on-year. Services and construction sold for final demand. It is one of the main upstream inflation indicators in the US economy and helps traders assess whether cost pressures are building before they show more clearly in the consumer inflation measures such as CPI and PCE. Give me a second, guys. Let me just turn off my notifications on my Teams call because it is going off over there at the minute and it's a little bit annoying. Right, so let's just mute that. So yeah, we have the which arguably PPI could be a bit more aggressive in terms of moves versus CPI. Everybody looks at the CPI, right? But what about PPI? What about PPI? Core PPI, right? It's expected to fall to 4.2% versus the previous 4.7%. Core PPI month on month is expected to hold at 0.3%. But this, it really here is showing us what producers are feeling, right? So what typically happens is, and why is this a front runner for CPI? Well, it's because producers will feel the impact of market movements before consumers will. Because what producers are doing, they are producing in line with current demand or future demand, right? So if they see that they're paying more now for certain products, or they're paying more now to produce certain things, they could then eventually pass the cost on to the consumer, right? And that's what we usually see in CPI. So PPI is actually a forward-looking tool when it comes to inflation, right? Now, like I said, if you look at the PPI year on year, that is forecast to fall to 4.9% versus the previous 5.5%. Core PPI year on year expected to fall as well. So if we do see the market coming in line with forecasts or lower, this could be pretty bearish for US dollars, because it could show that future inflation could fall in line with the central bank policy, right? Let's go take a look at trading economics, right? So we always remember, we want to be looking at these things before we go trade the charts. You know, it's always important to look at what is going on. So if I go to indicators here, obviously we have the inflation rate and things like that. So we have main indicators in here. So the inflation rate, prices, we have CPI, all that kind of good stuff. But then here, look, we have the producer's price inflation, right? So if I go to that, and we're going to go to America and have a little look at what's been happening here on the United States producer price inflation month on month. So throughout sort of February, March, April, we actually had a producer's price index which was increasing, right? So in that time from early 2026, what has been happening? Well, if we go take a look at the US dollar index from early 2026, just go to a daily chart, right? Look at what happened to price. This is 2026. US dollar got stronger, right? If it's been declining, so as it's been for the past few months, so from April we peaked at 1.1%, May was 0.6%, June was minus 0.3%. The average is getting lower here, right, on the producer's price index. So that could explain to us why we're starting to see a change in the US dollar, starting to see a change in yields. Because if we go back and have a little look at that chart of the US dollar index, April, we saw the market kind of peak, right, and start to decline, but then started to have a very strong run. Okay. Now we're starting to see those effects of lower inflation being priced into the market. Go take a look at those US 2-year bond yields. Market has been very, very choppy. 2026 has been bullish for the US bond yields. But if that starts to break lower, that's going to be bearish US dollars. Okay. So PPI, very, very important. Another one that we have coming up tomorrow, which is what I wanted to talk about in depth, was retail sales. Okay. Retail sales are also another important figure when it comes to the grand scheme of things of what's going on in the market, right? Retail sales show us demand from consumers, right? Are they spending their extra capital in the economy, right? So retail sales month on month is expected to fall to 0.1% versus 0.2% previous. And we have retail sales year on year expected to fall from 6% to 6.7% down to 6%. Now we do have a minimum and maximum on this. So we have the on the month on month minus 0.5 is the minimum, 0.7 on the max side. So that basically means if we shift and have a announcement that deviates towards the minimum and maximum, then that's going to create a more sustained move. Okay, so checking out the retail sales here, there could be an opportunity to see us break lower again. So if we have, let's say we have a lower PPI today, lower retail sales, that's going to mean that the market is going to price in less chance of rate hikes from the Federal Reserve. That means the dollar could get a lot weaker. So when we look at that US dollar index, we can see that the price has broken down recently, right? We've come up into these structure highs here. And if we get bad data today, we could expect a break of that 99 spot 50 handle, maybe even then a continuation down towards $98. Very much firmly on dollar weakness side of things at the moment. And that can affect all sorts of markets. Let's have a look at gold. Gold is starting to pull back a little bit, but I am pretty bullish gold. I actually think gold is a good market to look out for, right? I'm looking for the potential for gold prices to move to the upside. Okay, so if we're looking at the 4-hour time frame, we're breaking down, but this is good. I want to see price retrace. I want to see a good kind of pullback in the market. Every healthy market has a pullback. So we're at a level of resistance. We've got this $4,400 level. I want to see prices pull back. Maybe if we can get back to the $4,250 level, that would be good. And I'll be looking to go longs in here. At the moment, retail are very heavily long on gold right now. So we need to be aware of that. And that helps me move on to the last part of the day, which is the skill of the day. Make sure that when you are taking a trade, you look at certain signals, right? So if I go to retail sentiment on gold, we can have a look at where retail are positioned. 80.9% of retail traders are long at the moment, okay? 41% are underwater on those longs. So what does that mean? It means they are buying above current levels, okay? So you can see here, current price is 43.68. Look at all these longs above that, right? Majority of people are starting to get long above that level. We have 43.62 as a key level as well. So if we take a look at that, 43.62 isn't that far away, right? That's people that have been buying down towards these lows. So if we break out of this low here and this support, then gold prices could continue to trade down to that $44,250 level. And I always love looking at retail sentiment because it just gives us a little bit of an insight. So if I go to, if you go to my FX book and you look at Forex sentiment there, we can have a little bit more detail in terms of looking at it on a chart, right? So if we go take a look at gold, okay. So on my FX book, it's more 50-50, okay. Whereas on Financial Source, it's more 80%. But if we go take a look at the positions, and what happens is we can see that retail traders are reducing those short positions, okay, as price goes higher because they want to buy because price is going higher, right? And they are increasing their long positions because they're looking to try and buy on this trend. But the problem is when they get to a point where they're buying aggressively, we start to see pullbacks in the market, right? And then once they flip their mindset and go short, that's where we want to be going long, okay? So you want to be looking at that retail sentiment just to give a gauge of what's potentially happening within the market, okay? So that's another thing that we can look at. When we're looking at trying to trade in the market, have a quick look at where retail positioning is. If there is a big crowd towards one side, maybe you want to look at doing the opposite. And that would have worked out really well here for gold, right? Because you could have just looked at key areas of support, supply and demand. So you could have looked at the recent swing highs, rejection there, look for the short. Now we can see, obviously, we're building up some momentum around this area here. So I like the idea of price rallying up back into $4,400 and then selling off beyond these lows here, taking these stop losses that people would have been placing in on the way up. So that's all I got for you today, guys. I hope you enjoyed that video. If you did, like and subscribe, and I will catch you in the next one.